One of the biggest differences is if you think about a nonprofit and how they measure success is really the impact that they're having to carrying out their mission and to just helping individuals and society in general, where a for-profit is really focusing on maximizing return for their owners or their shareholders.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hantzmon Wiebel. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. On this episode, we are joined by Travis Simpson, a partner in our accounting and auditing department. Travis is going to talk to us today about some insights on nonprofit financial reporting. Thanks for being here, Travis.
Yeah, well, thank you, Clarissa. It's a pleasure to be here.
So tell us a little bit about yourself, Travis.
I've worked in the nonprofit sector since I started with Hantzmon Wiebel in 2002. I serve a lot of different nonprofits, but a lot of private schools and higher education foundations. Just really enjoy the work and the challenges that are present with nonprofits.
So certainly an expert to be talking to us about this today. So let's jump right in. Tell me what you mean by financial reporting and why is it so important to nonprofits?
Yeah, so when you hear the term financial reporting, a lot of times you think about the formal reporting with a balance sheet and the income statement, which for nonprofits is terminology is a little different, but it's the same theory. And then you have your cash flow statements, and for nonprofits, you have the statement of functional expenses. But also a big piece of that financial reporting is your internal reporting. So your budget to actual reports, cash flow projections. And I think it's important to remember that you're just looking at the output for financial reporting, but the processes and the key components of ensuring that the data is accurate and reliable. There's a lot of different usages for internal reporting and financial reporting. Management will use it to make operating decisions. A lot of nonprofits will use it for fundraising purposes. A lot of times there's compliance requirements if a bank needs it. Sometimes there's outside bonds that are held that require audits. Really, you think about the financial health of the organization. I tend to go into the medical analogies for some reason talking about financial items, but Clarissa, if you were to go to the doctor and let's just say you were doing your blood work, for whatever reason, the processing center messes up those results, and you and your doctor are looking at that information, and it's bad data, obviously, right? And you're making decisions that are not accurate. And for financial reporting, it's similar with the organization of the financial health. You want to make decisions that are in the best interest and the most informed decisions based on the information you have. And we don't always make the right decisions. People make mistakes, but hopefully it's not because the data was wrong.
Certainly. So you're just highlighting why having accurate data is so important.
It is. And in a lot of ways, it aligns with financial objectives of the nonprofit. What do you want to accomplish? But the oversight controls that financial reporting presents, budget to actual reviews, and finding things that look unusual and being able to ask those questions is very important for management, for potential board members, for loan officers. Pretty much all the stakeholders rely on that document.
Can you describe a few differences between nonprofit and for-profit reporting?
You know, the concepts of financial reporting are the same. But whether it's a for-profit or nonprofit, you want accurate and reliable information. But there are a few key differences with nonprofit reporting, one being the fiduciary responsibility of the nonprofit to honor donor restrictions. So if I give a contribution, I say it should go to purchase equipment for a new media room, the nonprofit should be able to capture that gift, the restriction, and the related expense, where a for-profit doesn't have that responsibility. Endowment reporting can get kind of confusing sometimes with clients, the difference between donor endowment and board designated, but the main takeaway is if you have a donor endowment, there are legal requirements to maintain that principle, which is obviously a big difference compared to for-profit. And functional expense allocations, which, of course, I know you're familiar with, but basically how much of every dollar do I spend that goes to program expenses and how much goes to management in general and fundraising. Those are key metrics that nonprofits have that a for-profit would not have to adhere to.
A lot of donors, they look at those on GuideStar and 990s.
They do. And sometimes, unfortunately, maybe a little too much. Some nonprofits are in different stages of growth. So if they're a new nonprofit focusing on fundraising, that functional expense allocation actually maybe should be higher to fundraising for them, but it's not interpreted that way for a lot of the watchdog groups that are out there. One of the biggest differences is if you think about a nonprofit and how they measure success, is really the impact that they're having to carrying out their mission and to just helping individuals and society in general, where a for-profit is really focusing on maximizing return for their shareholders. And that's not to say nonprofits shouldn't be financial savvy, because they need those resources, and they have to be able to make the right decisions to make sure those resources get in the right places. So a lot of times you hear like, oh, we're a nonprofit, we shouldn't make money. Well, that's not the solution. Like, you want to be financial viable and be healthy, and that means you eventually need to make money to do that. But just how you measure that and how you tell your story is different than a for-profit.
Yeah, so the focus just isn't on the bottom line,
That's
but more
right.
of the story that they're telling and the impact that they have on the community.
Yes, 100%.
So can you tell me about a few common weaknesses in financial reporting that nonprofits face, and maybe some tips?
One thing that comes to mind that we run into quite often is the chart of account structure that they're using. The chart of accounts is set up really to provide the framing of a house, or the foundation of what you want it to look like. So if you're looking at how you want a report to look like for the board or whoever's using it, the chart of accounts is what really you need to look at to make sure it's mapped in a way so that you can get that information. Because some accounts are way too voluminous. There's an account for every single thing you could think of, and then there's other chart of accounts that don't have enough. So sometimes it's just good to step back and look at the chart of accounts, and maybe there needs to be modifications, or maybe sometimes a whole revamp of a chart of accounts. That's one issue I see. The other one that we run into related to net asset fund tracking. So earlier I told you about the donor that gave for the media room. Their gift was restricted for that. So the nonprofit entity needs to track that somehow in their software, whether that's through the accounting software or sometimes through an Excel workbook. And what we see a lot of times is entities are not using a true fund accounting software. So QuickBooks would be a good example. QuickBooks is great for so many things, but it's not a true fund software where you can actually close that particular restricted fund down to a net asset balance. So sometimes we will have to work with the client and say, okay, well, if you're going to use a QuickBooks, you're going to need some other tracking software. And there are ways you can actually get QuickBooks to work for that. You can call Hantzmon Wiebel and we can work through that with you.
What about inaccurate or,
Oh yeah, I guess
untimely reporting is also a big
you.
item that we encounter.
Yeah, so the whole adage, it's kind of cliche, but garbage in, garbage out, right? So if you're making decisions on something that's wrong in the first place, you're probably not going to make the best decisions. So this is where the internal control process comes in, where you're going to have multiple checks. Somebody's going to be reviewing bank reconciliations, and feeds right into being timely as well. I mean, timeliness is a huge part. If you're not getting the financial reports until 6 months after the fact, hard to really do a good risk assessment. What I would recommend in that case is any type of checklist they can use for a monthly close, where it might be the executive director, in a lot of cases, needs to review the bank statements. They need to review the budget to actual, and there's a little checklist that they can go by. I encourage clients to get in the habit of coming up with a close cycle where they have so many days after the close where they have to issue those financials, because the longer you wait, the harder it is to really get back in focus. So a lot of the ones that do a good job of it close within 7-10 days afterwards and get the information out to their stakeholders and board members. One other common pitfall, I guess I could call it, that we see a lot of confusion in is the cash method versus the accrual method of accounting. This is always a challenge for board members to grasp, especially if they don't have a background in financial reporting. And a lot of organizations will use the cash method of accounting when they're doing their internal budgeting. And basically what that means is when cash comes in, it's income, and when it goes out, it's an expense. But in the accrual basis world, you're matching the actual economic transactions to the actual recording. So, for example, Clarissa, if you were to say, I'm going to pledge $1 million to nonprofit ABC or whatever, if that's not booked on your balance sheet, then the entity has no idea that cash flow is receivable, that it's due to the nonprofit. A lot of folks would say, well, it's not cash. Well, how do we count it? And that's where it's kind of difficult to sometimes educate. It takes a little bit of time. And some nonprofit entities decide that they want to operate on the cash basis throughout the year. What I would encourage them for that would be to supplement with some type of development report that shows pledges receivable, that shows some type of balance sheet where you have an understanding of what's expected. And the same thing works on liabilities, is what is actually due. So if you have a $500,000 liability and you haven't paid it yet, most folks are going to want to know that that's a commitment. So Always encourage the accrual basis method of accounting, so it aligns with the actual financial reporting that goes out to the public for general accepted accounting principles. But if they do operate on the cash basis, there's things you can do to supplement it.
When it certainly seems like supplementing that cash basis report would be so important to making future decisions,
Yeah,
right?
certainly.
Technology plays such an important role in our world today. As we close out, can you give us a few insights on how technology can aid in financial reporting?
So yes, technology continues to play a more involving role in financial reporting. And just through the COVID phase, I think there were some technology advancements that happened that were just inherently easier to adopt. And one was online bill pay. So you had folks that were not in their offices. They weren't coming in to look at invoices. So we've had several clients that have gone to systems like Bill.com, and there's a lot of other online bill payment systems that are out there. And that's also another step to going to paperless, which that's not new technology. Paperless has been around for a long time, but what we're finding is there's a lot of efficiencies for entities that decide to go paperless and being able to look up invoices with just a click of a button. I see that continuing to evolve. Cloud hosting seems to be developing in the last 5 years. It's forcing folks to go to more online. And what that means for accountants is we have real-time access to their data. You also hear a lot about automation. I know bots are being used to automate a lot of tasks. They're very tedious. System integrations is something that you see more of. Credit card charges that go straight into a system like QuickBooks. There's also artificial intelligence type of software that can go grab invoices and based on the description and the vendor be able to classify those invoices in the accounting system correctly. So all of these advances, they're really helping to streamline reporting processes. The asterisk I'll put with that is you have to be cautious with any type of new technology because if you have a systemic problem that keeps happening over and over again, it might be harder to identify that. So that's why your budget to actuals, your detective controls are so important for financial reporting.
Thank you so much, Travis, for the insights that you've provided today. I know they'll be helpful for our audience.
Well, thank you. This has been fun. Appreciate you having me here today. Do you know the next episode you'll be recording?
The topic? Well, it depends.